And what are the consequences of poor corporate governance? The consequences are value destruction, right? So, and we have just mentioned already about how we can improve corporate governance by ensuring that we have a greater number of independent directors in an organization.
My point is, corporate governance, if you have independent directors, but still the agency probably exists unless they have their own interest in it.
That's right.
How do you overcome that?
Well, one of the ways you can ensure that is rather than just paying them a cash compensation for serving on the board, you give them a stake in the business, you give them stock options, and when they know that their personal interests are also at stake, hopefully that will encourage them to do what is in the best interest of the shareholders. So that is one way to do this. Now here is an example how a board of a company acted in the best interest of the shareholders and thereby avoided value destruction. Okay, so not too long ago, CEO of Coca-Cola wanted to acquire Quaker Oats. All right. Now, what was the motivation behind this? The motivation was that Coke has traditionally been just a beverage company. So the idea was to move away from being a beverage company into more of a food company, a diversified food company. And that was the reason for the acquisition of Quaker. Okay? But this would have been a major shift for Coke because they would be getting into a business where they didn't really have much of an expertise in, namely the food business. Alright? So, and the board, which included Mr. Warren Buffett, who was until very recently a member of the board of Coke, felt that this was not a value-creating deal, and so they overruled the CEO, and the merger effort was cancelled. All right. So now let's see how the market reacted to this. As you can see, the moment that Coke announced that they were in talks to acquire Quaker, you can see the value destruction that has taken place, steep fall in the stock price. And then once the board overruled the CEO, you can see that the stock price dramatically shot up. Okay. Now before we get to WorldCom and the corporate governance, what happened to Quaker after that? This is kind of, I'm digressing from our topic here, but forgive me if I just take 2 minutes of your time to do that. After Coke decided they were not going to acquire Quaker, Pepsi decided to step in and acquire Quaker. Now, why did Pepsi acquire Quaker? Actually, because there was a big gap in Pepsi's product portfolio. The fastest growing segment in the beverage business was sports drinks. And the market leader was Gatorade, which had 85% of the market share. And Gatorade was a brand owned by Quaker. So initially Pepsi wanted to just acquire Gatorade and plug this gap in their product portfolio, but Quaker didn't want to sell Gatorade by itself. So they said, if you want Gatorade, you have to buy us. So Pepsi ended up acquiring Quaker, and the plan was that they will keep the Gatorade division and spin off the rest of it to the Pepsi shareholders, just like they did with regard to Pepsi's food business. You know that Pepsi decided to club their food businesses, namely KFC, Taco Bell, and Pizza Hut in company. Okay? So they were planning to do the same with regard to Quaker. But surprisingly, what happened was, after they acquired Quaker, the food business of Quaker started making money. So they decided to retain it. So it's kind of ironic because they wanted to get away from the food business. That is why they did a spin-off of KFC, Taco Bell, and Pizza Hut. But then now they're back in the food business, kind of indirectly because of the Quaker presence of Quaker in their business portfolio. So that is now we've talked about an example of good corporate governance just a minute ago. Now let's talk about some examples of bad corporate governance and how these can result in value destruction. Okay, WorldCom, you might have heard about WorldCom, very big, it was a big telecom company. Now it was run by a great CEO who was a very good deal maker, but was not a very good value creator. Right? So for a while the company was growing very rapidly, so everybody was happy, the stock market was happy, but eventually the whole structure crumbled, and that resulted in, see what happens is when you go on a rapid acquisition spree, your margins get squeezed. And you know the problem in the US, I'm sure. If you miss your earnings forecast by 1 cent, the very next day, 20 to 30% of the market capitalization running to billions of dollars gets wiped out like this. Okay? Massive value destruction takes place by 1 cent by missing your earnings forecast. So when you're acquiring companies left, right and center, your margins are under pressure. So that is why what happened in the case of WorldCom was they started fudging the books or cooking the books. So eventually that has resulted in Mr. Bernie Ebbers now being a guest of the US government in a prison for 25 years. So, but the problem is the board failed in their fiduciary duty, because the board members have a fiduciary duty to ensure that CEO does not do anything that is value destructive for the shareholders. But that's precisely what happened. Okay? So this is the reason why I wanted to have a brief discussion of corporate governance, is because if the board is effective, if the board discharges its fiduciary duties effectively, it can prevent value destruction. In fact, it can result in the creation of value for the shareholders.
Excuse me, sir, I have a question here.
Yeah.
Like you gave the example of Coke and Pepsi. Now the same thing was considered wrong for Coke, and their board, they rejected that CEO's proposal, and that went in their favor somehow.
Right.
The same thing went they acquired the Quaker, but that went in favor of Pepsi.
Right.
So ultimately, what is value creation and value destruction in business?
It depends. It depends on whether you have any prior expertise in a certain area. In the case of Coke, the reason why the market reacted favorably when the deal was cancelled is perhaps because of the fact that Coke had no prior experience in that area.
That is why I suppose they were acquiring Quaker, because they had the experience.
That is true, but the thing is, maybe the market felt that there would be some integration problems and so forth.
So
because
that means ultimately market sentiment rules the value creation business?
Absolutely. Okay, in the case of Pepsi, now the thing is, Pepsi had a lot of experience in the food business. So perhaps that's the reason why the market reacted differently. Okay. So, ultimately we can only speculate. Okay, so we don't know. So
that means, going by your logic, in the case of Pepsi, there is no value addition as such. You're only trying to strengthen your hands. Pepsi was already in the food business as such.
No, they got out of the food business, but they had expertise in that area. Okay. Now, why did they get out of the food business? Why did they spin off KFC, Taco Bell, and Pizza Hut? The reason was, this was actually Indra Nooyi's classic, brilliant strategy. The reason was, the food business was dragging down Pepsi's stock price, because the margins in the food business was very thin. And so what she felt was that if you get rid of the food business, you're giving up the revenue from the business. But if you can achieve an appreciation in the stock price that more than offsets the reduction in the revenue, then you come out ahead, right, at the end of the day. So that is what exactly happened. When they did the spin-off, Pepsi stock took off in a big way, right? And but then, one other strategy that she used was acquiring, apart from the Quaker acquisition that she is credited with, was she acquired Tropicana. So this enabled Pepsi to plug the gaps in the product portfolio. Alright, see, Pepsi wanted to reposition itself as a beverage and snack foods company. That is why they wanted to have a full range of products, beverage products, and have Frito-Lay for snack foods. So that is why they wanted to spin off Quaker. But then, if you're the CEO, if a company is making money for you, like Baker is doing right now, would you want to get rid of it? Probably not, right? And that's why they've still kept it. But eventually, I think they'll probably get rid of it. Alright. We all know about the Enron saga, right? So, what was the, how, this is an example of, classic example of bad corporate governance. Can somebody kind of walk us through this, what really happened at Enron? What is the main? How did Enron collapse? I mean, it was a spectacular collapse back in 2001, if you remember. The stock fell from $64 to less than $1 within a matter of days.
They were selling and buying between years of degrees and so profit was
Okay.
Special purpose vehicles to show all their bad debts into that. I'm sure their accounts as really rosy.
That's right. In fact, they shifted a lot of their liabilities off balance sheet by creating these off balance sheet partnerships. And once again, in this case, the board did not exercise their fiduciary duty and allowed this father and son team, the team, to get away with virtually whatever they wanted. And one of the things they did was they used to take loans from the company, never paid it back. So ultimately, the company collapsed and they're both in prison now. Now, Tyco is another example of a company where the board failed in its duty, which resulted in, see, Tyco is an example of a company that wanted to grow rapidly, very quickly. I mean, they wanted to grow very quickly, and therefore they started acquiring companies left, right, and center. And in fact, I'll give you an example how a very simple accounting change can result in manufacture of profits. See, one of the subsidiaries of Tyco was a company called Waste Management. In the US, they are the market leaders when it comes to garbage disposal, right? Now, Waste Management was growing very rapidly. And because they were growing rapidly, as we discussed previously, margins get squeezed, right? So they were under a lot of pressure. So what did they do? They used to have these big garbage trucks that used to cost about $150,000 each. They used to depreciate them more like a 7 to 8 year period. So they said, well, these trucks are good, they're well made. Why should we depreciate them over 7 to 8 years? Let's just extend the depreciable life. So instead of depreciating over 7 years, they decided to depreciate them over 15 years. Instantly, what happened? Profits were manufactured. Profits were created. Right? The moment you extend your depreciable life of any asset, it helps boost the bottom line, right? So once they did that, they realized, oh, this thing works. Let's extend this concept to other things. So they have these dumpsters, which are found at street corners in the US. They said, well, and these dumpsters were being depreciated over 5 to 6 year period. They said, these dumpsters are well made. Why should we depreciate them over 5 to 6 years? Let's also depreciate them over 15 years. So they did that, and instantly they manufactured profits. So within a short span of time, they were able to create fictitious profits of $670 million. Now, don't tell me that the board did not know what was going on. I'm sure that the board members knew that this was just an accounting gimmick that resulted in boosting of the bottom line. But once again, they failed in their fiduciary duty and allowed the CEO and the other senior executives to get away with this. Had they exercised their role effectively, it could have resulted, in this practice not having taken place. So ultimately, it was a case of bad corporate governance. And first of all, they would not have allowed Tyco, if the board had been effective, would not have allowed Tyco to go on this massive acquisition spree. Okay, so now another example of bad corporate governance which results in value destruction. There was a CEO called Mr. Al Dunlap. He was CEO of several companies like Sunbeam, Scott Paper, and so on. Now what used to happen was, the moment he joined a company, the first thing he used to do was announce a massive cost-cutting campaign. Lay off 10,000 people, 15,000 people. Instantly the stock price used to go up. So he was apparently creating value through his cost-cutting measures. Alright? He was also known as Chainsaw Al because he used to cut costs ruthlessly. But the key question is, and he was able to get away with it because nobody on the board opposed his moves. But the key question is, this sort of strategy, did it create value for the shareholders or not? And I actually did a study where I looked at the stock price of these companies prior to Mr. Dunlap becoming CEO. And then eventually after he left that company, I looked at the stock price or I tracked it over a period of time. And what I found was, eventually the stock price fell to a level lower than what it was before he became the CEO. So in other words, the appreciation in the stock price was just a temporary thing. Ultimately, this sort of strategy resulted in, value destruction, not value creation. Okay, same thing. I might give another example. Before Lou Gerstner, I'm sure some of you read this book, Why Elephants Can't Dance, by Lou Gerstner. If you haven't read it, perhaps you should consider reading that because it's a great book on corporate strategy.
Who says elephant?
Yeah, who says elephants can't dance? Exactly. Thank you.
Very good book review now of this in Hindi last week.
So now, prior to Mr. Gerstner, the CEO of IBM apparently was an art lover. Okay, so he bought expensive paintings using shareholder money and had it hung up in his office. Okay, who paid for it? He didn't pay for it. The shareholders paid for it. Okay, so this was an example, and obviously he had to get the approval of the board, and the board approved it. So this is another example of bad corporate governance. So what is the solution to this? We've already, I think, talked about it earlier. So having a majority of board members as independent directors perhaps will alleviate this. And also having a compensation package structured where there are performance-based incentives and stock options that might also help to avoid this kind of activity. Okay. Any questions? Yes?
But the different experiences that you enroll in all that, can you draw inference that, by adopting or applying unethical means, well, you may get some content gains? And we had the experience in India also. But in the long run,
yeah, that's true. In the long run,
ethics in management.
what goes around comes around. Right? Eventually the game is up. But the point is, the problem, especially in the US, is, the markets have a short-term focus. So, in your stock options, if you're the CEO, become more valuable, which if there is a spike in the stock price. So even what happens is that you lose some short-term fix that results in the price going up. You cash your stock options, then move on to another company. So that who cares what happens to the company in the long run? Yeah, perhaps that would help.
There are some CEOs, they don't want to wear something like this. They don't want to
Okay. Now, what I'd like to do next is walk you through a recent real-life acquisition of a Chennai-based company called TAFE. TAFE is the second largest tractor manufacturer in India, tractors and farm equipment. They acquired Aisha Tractors. And let's try to look at this deal. What was the motivation? How did this deal end up being a success? And so on. Okay, so these are some of the things we'll be discussing. How M&A can be used as a tool to manage in turbulent